U.S. stocks enjoyed an unrestrained run up toward records on the week. This, all with the assistance of the Federal Reserve. Recent gains have put the Dow Jones Industrial Average on the verge of its best June since 1938 with a gain of 7.7%. The S&P 500 is on track for its best June since 1955 with a gain of about 7.2%, while the Nasdaq was on track for a 7.8% return in June, which would represent its best June since the year 2000. Well, the Russell 2000? Not so much. The elephant in the room was the Fed, which concluded its June meeting by signaling easy money as soon as the end of July. This would help offset the tariff dispute between the U.S. and China. As a result, the charts have made a U-turn upward. That being the case, we are near the extreme highs for most of the indexes, so it makes sense that we may struggle here near the top. However, you must remember, for now at least, the most important thing in the world is the Federal Reserve and not the economy. If the Federal Reserve is willing to loosen its wallet, Wall Street will buy stocks. So, let's take a look. And we're looking at the 20-year monthly chart on the spiders, the SPY, and the close on Friday was 294 even. Bounce off of that 50 EMA. We're up here near record highs. So the important thing is down here in the MACD. About 4 or 5 weeks ago, the three of you that saw the video should remember that I was talking about this formation here being similar to this formation in 2015, 2016 with the move up, reflection back down, and then the secondary move on up lasting for a good, say, year or more. I think that's what's going to happen here. We had the move up, the reflection down, and now we're heading back up. And I believe this is probably going to extend for maybe a year, perhaps longer. So I think we're on our way up. Histogram, bottom, and a very strong move upward. Same thing here in the price rate of change. Nice basing, just barely above that zero line. Not unlike this basing here, or perhaps maybe a little bit of that basing there. So above that zero line means we still have some strength, and it looks like it's getting stronger. Here we are in the relative strength. That also has a move, but it came below that 50 line, not unlike it did in 2015, 2016. Here in the stochastics, this looks much stronger. That basing above the 50 line, similar to 2015, 2016. And with easy money, who's going to stop this? Volume looks fine, and the Williams looks like the other oscillators. Back on up here, I think that we're going to have some trepidation here at the top, a little bit of struggle as I indicated in the intro, but sooner or later that easy money is going to take hold and Wall Street's going to buy. Let's quickly take a look at the weekly chart. And we're now looking at the 2-year weekly on the spiders. And this is what I want to refer to here is this point there, which at that time the Fed was starting to telegraph some easy money. Now the easy money hasn't come through yet, but the signal is very strong. And so the market did a U-turn. Came down to this point, a turn on a dime and headed on up. Easy money is Wall Street's favorite characteristic. And you can see that odd circumstance here in the MACD when we were heading on down and actually started to get steeper, but then all of a sudden hit the pavement and then did a 90-degree turn and it's heading on up. That's very unusual. This is somewhat unusual here in early 2018, but I think gravity still took hold and the market came down here as well. Not really all that unusual, but gravity took hold and it came on down. Now, easy money is levitating to the market. So that's one thing you got to keep in mind. And you got to be able to change your opinion of the market when you see these things happen. So we were looking, I was hoping for this thing to have a much more normal and healthy downturn. and then have the market recover in a typical fashion. But the Fed got in the way, and the Fed is looking like they're going to provide that easy money. So we need to recalibrate. So keep that in mind. So for today, that's ChewDog Charts. Thank you.